than if I basically deposit my money for 1 year. Okay, so generally what we see is longer term rates are higher because of this risk. Okay. And again, it's up to the individual investor to decide what's good. On the inflation side, again, money is only good for what you can buy with it. So at the very least, you have to have an interest rate that will return inflation. So if prices go up by 2%, I need 2% more money next year just to stand still. So at the very least, the interest rate will be 1%. Of course, if I want compensation for risk and I want compensation for performance and consumption, they have to be greater than 2%. Okay. And then, of course, taxation. In Ontario, the top rate, 46%. If you're making more than $125,000 a year, this is taxed just like earning income at the top marginal rate in the province of Ontario. So essentially, if I'm getting 2% from the bank, let's say I get $1,000 worth of interest, because I've got a lot of deposit, the government gets half of it, $500 in taxes or $460 in taxes. I only get $540. Right? So I need to essentially gross up my before tax return by the tax rate here to make sure that I've got enough money to keep up with inflation. Okay, so the tax factor comes in as well because I can only spend after tax dollars on it. So it's sort of that interplay in the marketplace between supply and demand that influences the rate, and then it's investors deciding whether or not they're being compensated for all of these factors adequately that ultimately decides whether they'll invest in one type of asset class or another. So that's sort of the mechanism. Now, to give you a sense of the marketplace out there, these are called fixed income securities. In other words, there is an interest rate which is stipulated up front, which they will pay. And it's a fixed term. In other words, they'll give you your money back at the end of the term. So this is what's called a fixed income security. And as we talked about earlier, yes, I can get investors to invest in risky propositions, but I have to pay them more. Right? So there's this risk premium for risk. And let's look at the different types of fixed income securities out there and how interest rates might sort of react. Think about the type of investment that is as risk-free as possible. Nothing, of course, is totally risk-free. And we call that the risk-free rate. Think about governments. If I basically buy a treasury bill from the United States government, I'm buying, basically, I'm lending them some money for a term. Well, what's the chance they're not going to pay me back? Well, it's probably pretty small because the government, if they run out of money, can print money. Right? So I'm going to get my money back. It's risk-free. Of course, the value of that money coming back, if they've got the printing presses roaring, is less. That's inflation. But in terms of default risk, I'm going to get my money back. Now, you might say every sovereign nation issuing debt has the ability to print money, and I'll get my money back. However, if I get a U.S. Treasury bond right now, I think it's paying 2 or 3%. If I buy a bond from Greece, which is having all sorts of financial difficulties, I'm going to get a return of about 25%. A little while ago, I could get a return of about 35%. When you say sovereign nation, well, they necessarily won't be able to print EUs to pay back. And so, of course, if I'm looking at Greek bonds, if I think they're not going to pay back, that they're going to default, I'm not going to buy a bond from them, right? Because I'm not going to get paid back. So obviously the people buying those bonds right now basically say, well, yeah, there's a risk that they're not going to pay back, but they don't believe that the European Union will let Greece fail. And they believe that France and Germany have the resources to make good. And so rather than putting their money in 2% treasury bills from the United States to get a guarantee, they're taking a chance. And if they're right, they're going to be handsomely rewarded with a 25% per year return. Or if they're wrong, they're going to have worthless bonds. Okay. So again, it's this notion of, going forward, I don't know. I have to make a reasonable approximation and then decide what to do. The greater the risk, the more I'm going to demand as a return, or else I'm going to say, I'm just going to put my money, if Greek bonds were paying 4%, I can guarantee you no one would buy them. They'd rather get 2 or 3% from the U.S. At 25%, there are people buying. So let's look at governments. Well, your governments that are not about to fail generally can issue debt fairly cheaply. Why? Because they have the ability to tax, and they have the ability to pay those bonds. That circle here indicates that there's different types of government bonds available. Some basically return a little higher than others. Well, think about the larger the government, the more people they have to tax, the less likely they're not going to pay you back. So if I look at the hierarchy here, perhaps a City of Toronto bond, actually the Montreal just paid off their bonds from the 1976 Olympics. They ran into a little bit of shortfall and they had to borrow $1 billion or so, and it took them 25 years to pay back. They, of course, would pay a higher rate than, let's say, the province of Ontario, because there are more people to tax. And the province of Ontario would pay a higher rate than the government of Canada, because there, you know, you've got 30 million or so to tax. The chances, and you have to control the money supply, therefore the chances are less. So, the smaller the government, the higher the rate. If there's a chance of default, well, then of course the rate basically skyrockets. I should note that the University of Toronto really is in this sort of government bond game, because we, and I'll talk about it when we talk about bonds, go to the bond market. As it turns out, investors think that we are a much better risk than our political masters, the province of Ontario. We get a much better rate than the province of Ontario. Well, why? Well, we've got all of you students coming back every single year paying really good tuition. We've got $8 billion worth of real estate downtown. We've got an endowment of about $3 billion, $2.5 billion. Stock market's not doing so well. And so we are a good risk, better than our political masters, you know, McGinsey and company. So anyway, we take advantage of that because we try to get the money as cheaply as possible. And of course, try to keep tuition down as a result. Okay. So this is on the government side. Now think about your normal blue chip company. Blue chip is just a chip that's used in poker, the one of high value, and these refer to companies that are good, sound, you know, enterprise, that they're not going to fail, that they're going to pay back their loans. You know, your IBMs, your Bell Canada Enterprises, those sorts of companies. Well, yes, they can borrow money reasonably cheaply. Of course, there's always a chance the company can go under, right? They don't have printing presses. When they go under, they go under. And so they're going to have to pay more than governments. But if you're a blue chip company, the chance of not paying back is fairly small, and you can borrow money quite reasonably. Certainly a lot cheaper than going to the equity markets. I remember that debt equity conversation we had earlier. Okay, other corporate bonds, so if you're not a Bell Canada Enterprise, you're a smaller company, yeah, you can go to the bond market. It may be private placements, but you're going to pay more. A smaller company has a greater chance of going under. Companies in difficulty, way over there. Okay. Well, these are called junk bonds. Okay. A junk bond is something that's paying 20, 25, 30%. Why? Because there's a chance that you may not get anything back. Okay. And so companies in distress, or governments in distress, like Greece, are in the junk bond category. Now, why would I invest in a junk bond if I think the company is going to go under and not pay me back? Well, I wouldn't, right? If I knew for sure the company was going under, I wouldn't invest. But if I assess all the factors, and I look at it and look at the lay of the land and say, yeah, there's a chance this company is going to go under, but I think it's not because of this, and this, then maybe I'm going to take a chance. I'm going to buy the bonds, and if I'm right, I'm going to get a 25% rate of return. Much better than putting my money at 3% in a treasury bill. If I'm wrong, I get nothing back. But the key thing is, I'm making my assessment saying this company is not going under, they're going to pay me back. And I'm going to be rewarded handsomely. Okay. So there's a continuum here, and again, we get through this risk-return relationship. You know, the greater the risk, so risk-return. And so what we're seeing here is really fixed income securities that investors perceive as we move along here as being riskier, where risk is the chance of not getting paid back, versus the interest rate that they demand to basically buy those securities. Okay? And this is just what you see out in the marketplace. So that's the corporate side of things. I always like to talk about the personal side of things as well. And so I've got a circle here called mutual funds of corporate and government bonds. Think about if you're an investor personally. So, you know, once you get a good job, you're going to have surplus cash, right? Let's say you got 50 grand. That's pretty good, actually. Well, what can you do with that if you don't want to take much risk? Well, you can put it in the bank, and you take absolutely no risk because the government of Canada backs every bank to the tune of $100,000 in case it fails. So, no risk. But you'll earn 2%, 3%. Or if you want to be a little more risk taker, you can say, I'm going to buy a bond from Bell Canada Enterprises. What's the chance that I'm going under? Well, pretty slim. But it could happen. And they're going to pay me 5%. Okay, and I'm now going to look, a little bit more risk, but 2.5 times the return, hey, that's a good deal. But think about what you've done. You've placed that entire $50,000 at the mercy of Bell Canada Enterprises, and so all of your risk of that investment is with one company. And maybe you'll accept that. But oftentimes, people will say, I'd like to diversify. Well, the key thing here is you can't buy bonds for $10, right? They're big. You know, you can get $5,000, maybe $10,000 bonds, but most of them are $50,000 or more. And so, recognizing that demand for diversification, financial companies have set up mutual funds, which are regulated by the government, where I give the mutual fund company $50,000, as do a whole lot of other investors, and they take that money and, let's say, buy 20 different government bonds and 20 different corporate bonds. They've diversified my $50,000, and now I have a chunk of 40 different bonds. What's the chance of all 40 companies and governments going under? Well, it's almost zero. And so I have far less risk than if I took my $50,000 and put it into one company, where if that company goes under, I lose most of what I have. Okay. So from a personal finance point of view, a lot of people like mutual funds, and you can go on the equity side, you can go on the bond side. We talked about expected rates of return when we talked about compound interest, different classes before and after tax. So where does it sit now? Think about now where it sits in terms of risk return. It's a little less risky than buying individual bonds, but the return is less. Why is the return less? Well, because you've got a financial intermediary that needs to make some money, right? So they are taking a percentage of the interest to run the company. But of course, investors are willing to accept that because that mutual fund of bonds is far less risky than an individual. And it charges around 0.02%. So every year, 0.02% of your $50,000 is the fee. For many, that's a very small price to pay for diversification. A very, very popular investment vehicle for folks who don't want to take a lot of risk. Okay. So essentially, we've got this continuum now. Investors assess the risk, decide how much return they want, and then, depending on the price of the security, decide whether or not to buy it. In this part of the course, we talked about how that price is determined and how it fluctuates in the marketplace quantitatively. Okay. Some examples here, just really, if I want to buy a risk-free government bond, and I'm demanding 0 for risk, because I'm going to get paid back, so I don't need to be compensated for risk. If I'm expecting a 2% inflation rate, okay, and I want 0.5% for not being able to spend my money. And let's say I'm a well-heeled investor, I'm a good engineer making a solid income of $130,000 a year. I'm paying about 50% tax. So doesn't that mean that the bond has to pay 5% for me after tax to be left with 2.5%, which is what I'm demanding in terms of this risk-free deal. So this is how the formula works. And investors then are looking, they're only paying 4%. That's not enough for me. I got to find something that's more satisfactory. Maybe I have to take a little more risk. Okay. If I'm looking at a blue chip company, maybe their chance of going under is very small, and I don't want much for risk. So maybe I'm willing to sell 6%. Or in a smaller company where there's always a good chance, 10, 20% chance that I may not get paid back. Maybe I'm going to demand risk premium like this, and they'll have to pay 15%. Okay. So again, I'm looking at the factors going forward, trying to assess the risk. Am I being compensated enough for that? That determines whether the security gets sold in the marketplace. If it doesn't, and they need the money, well, they pay more. So we'll look at how that works in terms of pricing a little later on. So again, risk-return relationship that we're seeing played out in the fixed income security marketplace. Well, let's talk a little bit about the calculation. This is really arithmetic, so I won't spend much time on it. Interest can be calculated in North America 2 different ways. Okay. Simple interest, where essentially I'm just paying rent on the money that I've owed, or that I'm owing. Or compound interest, where the lender says, yeah, you're going to owe me interest for what you borrowed, but I'm going to calculate your increased indebtedness based on the interest you owe me as well. So it's interest on interest. Hence, each year the interest that you owe from the last year gets factored into your increased indebtedness. I'm going to pay more interest because I'm paying interest on interest. See how it works. Well, simple interest says, I'm going to borrow $2,000 for 2 years, and the rent on that $70 a year. So at the end, the future value, F2, after 2 years, $11.40. In other words, I've paid $140 worth of interest, $70 a year. The compound interest says, well, compound, first of all, is just a fancy word for saying calculated interest. So if it's compounded annually, it simply means I'm calculating it annually. So at the end of the first year, the computers do a calculation and say, oh, first year interest, $70. However, going forward, you're going to deem that you no longer owe 100, but 170. Excuse me, 1,070. So in other words, the principal amount of 1,000 plus $70 for the first year. Okay? And so for the next year, you're paying interest not only on the 1,000, but on the 70. Hence, you're going to owe more. And the difference, $490, is 7% of that additional $70. Okay? And so you're going to owe more. Now, banks, of course, prefer more money to less money, and this is compound interest is the way that things are done in North America, virtually for everything, except for bonds, very simple calculations. So we'll use compound interest for virtually everything we do in this course. Okay. We then have this general expression where we call this a compound factor. Okay. And this is greater than 1, and that's why it's compounding. It grows, money grows over time for the time value number. But we always use compound. Okay. Now, let's just see how we might use this for two situations. One is, how much are we going to owe at the end of the loan period? Or if I've got a target in the future, what do I have to put in the bank now to achieve that target? Future value, present value types of calculations. Well, my definition of present value, equivalent value of an amount of money at time t equals 0. Okay, well, I've got I as the time value of money. That will basically tell me that trade-off between now and money in the future. Well, if I've got a $1,000 loan, 6%, and I'm going to pay it back in 5 years, and it's compounded, i.e. the interest is calculated at the end of each year, then I've got this 6% factor compounded 5 times. 1.3382 is the number, and so I'm going to owe $13.3820. If it had been simple interest, what would it have been? Well, if it's simple interest, 6% is $600, or sorry, $60 a year, and so I would have owed $1,300. But the fact that I'm paying interest on interest each year after the first year means I owe another $38.20. Okay, so just interest on it. If I have a target of 2,000, how much do I need to put in? Well, it's going to be less, right, because the money's going to grow. And so this is the compound factor. 1 over 1 plus I to the n is a discount factor. It's less than 1. Okay. And so, again, I just use two compounding factors here. 1,780 will grow to 2,000 over 2 years. So that's hopefully quite straightforward. Now, we've got some symbols here, and when you're doing valuations of financial securities or properties or projects, we normally look at the project, we look at the relevant cash flows, and our first step in valuation is using these symbols to indicate how we go about valuing things. This here is a symbol for future value. So we'd read that I want F, I want the future value, given P, a present value. I is the operative interest rate per time period, N is the number of factors. It could be a year, it could be a month, it could be a day. Generally never more frequently than a day. And we call it a compound factor because 1 plus I to the n is greater than 1. We have it all calculated out of the back of the textbook. And these are all the factors. Normally most problems are integer interest rates, so you just go into the back of the textbook rather than do the calculations and come up with the factors. So for each of these symbols, you can just replace it with the factor to get the final answer. Okay. And so in this case, exactly the same. We come up with the factor 13382 by going into the table on the 6%, 5 time periods, and we've got the number and we're done. And everything under is greater than 1 because it's compound. Flip side of this is I've got this $2,000 target. How much do I need to discount that in terms of figuring out what do I need to put in the bank now? Well, symbol, I want P given F, so I want a present value given a future value, $2,000, 6% times 2. Again, it's a discount factor because it's less than 1, so all of these numbers are less than 1. I look in the table for P given F, 6%, comma 2. I find 8,900, and I'm done. Okay, so very, very straightforward. I always suggest that, in case you make a mistake, simply do not put all of the calculations through a calculator and give, the answer on a test, because there's nothing really to see where the mistake has been made. It's always very, very useful to write the symbols down in terms of your valuation and then do the calculation. So if there's a calculation error, you still get virtually all the credit because you've done the valuation correctly using the symbol. Okay. There are 2 sets of tables, so this is a caveat in the textbook. The first set are the ones that we use because they're just discrete compounding. So they deal with annual or semi-annual or daily interest, which is the way that we do things in North America. The second set of tables are more of a theoretical factor. They're continuous compounding. So think about if rather compound every day, I do it every microsecond or every nanosecond. You might think that means that you're going to have infinite interest, but no, it actually is asymptotic to a number. Okay. So when we use continuous compounding, we get equations that are easy to deal with for derivations and proofs and what have you, but business never uses them, and so we won't talk about that in the course. It's more for theoretical underpinnings of all the stuff behind this. So in business, we use the first set of tables, the discrete compounding factors, and just keep that in mind. A lot of students put tabs in the textbook so they can get there really easy on a quiz in terms of which tables are right and which ones to ignore. And I do recommend that you use the tables rather than calculating everything, but that's of course up to you. Let's use all of this to try to value something, and something that looks awful lot like a project. Okay. Project distinguished by a large investment up front. Remember, end of year 0 is the same as the beginning of year 1. That's when the project starts, right? So in this project, we're spending, for the sake of argument, $5 million on some investment. The engineer then has to estimate the useful life of the equipment in that project. In this case, the engineer said 4-year economic life. Therefore, let's have a 4-year planning period. And then the engineer has to determine, well, what are the revenues, what are the costs? And so R minus C, revenue minus cost, hopefully positive in a good project, look like this. It's all a forecast. Right? And then the issue is it worth trading off $5 million now for all of these returns over the next few years? Okay. There are 2 ways of looking at this. Okay. The first slide here is the way that we normally do things in engineering. We address the question, how much value does a project add today? The second approach, I think, is more intuitive in terms of what's really happening. And if it's a good project, presumably shareholders are wealthier at the end. And the other view is, let's look at the end of the project and look at shareholder wealth. But I want to start here because this is how we do things in engineering normally. Well, what do we do? Well, we need to consider when these cash flows are occurring in terms of determining how much value is created today. So if I spend $5 million today, my reasonable expectation is that there's $1 million revenue minus cost that's going to occur as a result of that investment a year from now. How much value does that add today? Well, I've got to account for the fact that the opportunity cost of investors is 10%. Right? So I've got to discount it by 10%. Okay. So this first cash flow, this term here is just the numeric representation of P given F, 10%, comma 1. Okay. P given F, 10%, comma 2. Okay. And so if I look up these factors, do the calculation, I come up with around 1940. So now you ask the question, well, is this a good project? Well, am I not spending $5 million to gain around $1.9 million worth of value? Well, in a way, yes. But look at this equation. Have we not factored in this $5 million investment as a negative? So isn't this the net contribution of the project? In other words, if I reasonably expect that, and that's going to happen over the next 4 years, am I not creating $6.9 million worth of value? Because that's the value of these terms, right? Because it's 1.9 above the 5,000. So the project cash flow generates $6.9 million worth of value, and I'm only spending $5 million to generate that. It's a good project. As we'll see, the rate of return is greater than 10%. Okay. The way to look at it is the value, okay, if we go ahead with this project, and the stock market recognizes the fact that this is a good project and this is going to happen, aren't we, as a result of making this investment today, a $1.9 million more valuable company? Because we've got this enterprise, we reasonably expect if our engineers are any good that this is going to happen, and therefore we now are more valuable by 1.9. So this viewpoint would suggest how much the stock price should increase as a result of this investment. Right, so if there's 1 million shares outstanding and everyone believes us, they want an action now, part of the action here, because this is returning more than 10%. People are buying, share price should go up by about $1.94. Right, 1.9 million and 1 million shares. So that's the viewpoint here. What value are we adding today to the company as a result of this enterprise? And that should flow out, if investors believe it, to an increased share price, because that is what mirrors the value of the company. Okay. So that's the first view, but it really doesn't tell me what's going on in terms of these 10% and the valuation. Okay. Next slide, just some symbols. So what we're doing in a project then, and this is really the domain of Chapter 4, we look at the different ways of evaluating projects, is we identify the cash flows, the investment, the revenues minus cost. So in this scheme here, A0, the cash flow at the end of the first year, or sorry, end of year 0, the investment's usually negative, and then hopefully all of the other A's are positive. Revenue exceeds cost, but not necessarily. We could have a slow starter and lose the money in the first few years, and then make a whole lot of money towards the end of the project. That still might be a good project. And so all we're doing then is identifying the investment, a minus number usually, and then the cash flows in terms of when they occur, and the opportunity cost, which will be, in this course, the cost of capital. That's the minimum return we need on the investment, because that's the opportunity cost to investors. So that's sort of the methodology. This is the arithmetic behind it. Well, let's look at the other view. This is the view of, well, how rich will an investor be, or how wealthy will an investor be as a result of taking this investment? And the way to measure that is, again, remember this notion of opportunity cost. The opportunity cost is what they can do elsewhere. Right? We're always being measured as engineers in terms of what can we do versus what can others do. And if we want the money for investment, we better do better than what the rest of the marketplace is offering, or at least we could. So this notion of opportunity cost is what can the investor do, and how wealthy will that investor be as a result of this opportunity cost investment. So let's just look at the arithmetic here first. All I'm saying is I want to figure out what this thing is worth at the end of the project's life, 4 years from now. Well, isn't that a future value? And so I'm going to look at all the predicted cash flows and bring them forward to end of year 4. That is a measure of the wealth generated by this project at the end. Well, how am I going to do that? Well, I've got my F given P, 10%, comma, whatever. And so if I'm only going to bring these cash flows forward, well, this thing here, isn't it 4 time periods? So 1, 2, 3, 4. So I'm just going to restate that blindly, F given P, 10%, comma, 4. This one here, well, that $1 million is in the company for 3 years, F given P, 10%, comma, 3. This last guy here occurs right when we're valuing the project at the end. It doesn't get adjusted, right? $3 million comes in, the end of the project, that's when we're valuing. And so I've got a number here, which is 2.84 million. So I've got a project that's going to generate future value of 2.84 million. Well, what does that mean? Does that mean that the investor is, or investors in total, are wealthier by 2.8 million? Or does it mean something else? Well, let's ask the question, if the investor looks at this and doesn't like our company and says, I'm not going to invest here, what can they do with their money? And what's it going to be worth 4 years from now? Well, isn't the definition of opportunity cost what they can do elsewhere with their money? Right? That's how we're being measured as engineers. Now, if I now look at $5 million being put somewhere else, isn't the future value of the opportunity cost investment, isn't that What do you think? Because we're saying, I'm not going to take this investment because I don't like this company. But I've got 10% opportunity somewhere else, so I'm going to take my $5 million and I'm going to invest it somewhere else. Well, the return, by definition of opportunity cost, is 10%. Does that not mean that this investor then will have this amount of wealth somewhere else? Okay. Is that okay? Just $5 million growing at 10% a year. Now the question becomes, did that investor make a good decision by doing this versus that? Well, what does this number say? Doesn't this say that this investment is $2.8 million better than the opportunity cost? Because what is this numerically? Well, isn't this saying 5,000 right? Isn't that, or the rate of return on this project, as we'll see when we talk in terms of rate of return, is greater than 10%. So the investor would be foolish to put the money here, because he'll only end up with this, whereas if he puts the investor here, he'll have $2.8 million more at the end. So when you're looking at a future value, you're addressing the question, how much better off is the investor vis-a-vis the opportunity cost investment? Not simply, how much money is he going to have? And as it turns out, think about if this just pays the opportunity cost. Well, doesn't that mean that the future value of the cash flows from the project exactly equals this? Therefore, this is zero. So where they're the same, in other words, this thing's returning exactly 10%, future value is zero. In other words, there's no value here beyond going up. So as soon as this number is positive, it's a better project than the opportunity cost is going to be. That's the way to look at it. This is sort of key to understanding, fundamentally, all of the stuff we're going to do over the next few weeks. And we've got this opportunity cost. We're measuring, are we doing better? In other words, are we creating value at the end of the project beyond the opportunity cost investment? If this number is negative, then of course the value of the project is less than the person that can do elsewhere, and we shouldn't move forward. We'll stop right. Any questions? Please.
This interest rate, if they can generate more money from this project, does that mean that kind of gives them the ability to drop the interest that they're paying based on the 10%?
Well, let's say investors, remember, we've got existing investors in the company who've already bought in, right? And so engineers, are really responsible to finding good opportunities, and so we're going to try to do the best we can, right? And so in this case, if we need new money, what's going to happen is the share prices are going to go up, because for our type of company with a certain risk, there's a certain return, and this is returning more. So it'll make the new shareholders more wealthy, and it'll make the existing shareholders more wealthy as well. Because the company now will have share prices that go up by $1.94, right? From this view, there's $1.94 million. Let's say the company has 1 million shares. So the share prices go up by $1.94, right? And so existing shareholders are wealthy because they early bought into a company that has the potential for doing well. People paying $1.94 a share will now get their 10% return. So that's been squeezed out for new investors. That's the way to look at it. Please.
You have to account the fact that I is changing over time.
Oh, yes. Yes. I mean, supply and demand and uncertainty, it's just all over the place. But I mean, fundamentally, unless there's a major shift, things for a certain risk class stay within a range. None of this is an exact science, but I mean, it is. And oftentimes, engineers get advice from investment bankers when it comes to raising money, especially in small companies, as to what investors demand and how we should make that trade-off. Not obvious to engineers. We don't have that trade-off.
Could you simply describe what's the difference between this graph and the previous graph?
Sure. Okay. This graph here identifies the value that's added to the company today as a result of undertaking this investment. So if the engineers in charge are correct in their forecast, and this more or less happens, This generates $1.9 million worth of value, right? So spend $5 million now, and the value of those project cash flows, $6.9 million, hence a $1.9 million increase. So if I'm an investor looking at this, there's value here, right? How much value per share? Well, think about if there's 1 million shares outstanding. I've got $1.9 million worth of value being created. My company's more valuable by $1.9 million, therefore share prices should go up by $194. That's the way to look at it. So essentially, you know, value of a company, as we'll talk about in Chapter 4, is the present value of all future earnings. Here we've identified a project that has superb earnings, therefore the value of the company goes up. That's the way of looking at that. Okay? And that's the normal way we do things in engineering analysis. This view addresses the question, how wealthy will a shareholder be at the end? But in a very technical way, how much more wealthy will the investor be than if that investor had invested in the opportunity cost investment? Right? So I don't have this worked out. I don't know if anyone's got a calculator, but let me just throw some numbers out. Let's say the opportunity cost investment gives us a value, and I don't know what it is, of $6 million. So if I don't invest in this company, I take my $5 million, I'm going to invest it in another company at 10%. Sake of argument, I'm $6 million. I have $6 million at the end, year 4. What this analysis suggests is, by assumption, this number is $6 million, and all of this is $2.8 million more than the $6 million. So it suggests that the future wealth of the investor here is going to be 6 plus 2.8, 8.8 million. Right? This being 6 million, and then this being 8.8. So he's $2.8 million better than having gone somewhere else. That's the way to look at it. So not total wealth, but additional wealth beyond the opportunity cost investment. So if it's 0, it means that we're returning exactly 10%. So he's no better off here or there. Greater than 0, it's a good investment because there's additional value. That's the way to look at it.
So do you normally look at the future value or the present value?
In engineering economic analysis, we ask the question, what value is being added today as a result of this decision? Because that's the way we look at things from a share price point of view. Right? So how does the share price react to this particular investment in a public sector, a publicly traded environment? Okay. And this, I think, is just intuitively more obvious in terms of generating wealth. You think at the end of the project, how wealthy is the person? Because from a present value point of view, it's less obvious. I mean, yes, the share prices have gone up, but why? Well, they've gone up. Why? Why have they gone up? Because if this plays out as the engineers have forecast, the investor after 4 years will be more wealthy. Right? That's why the share prices go up. People are buying into that. And so these are just sort of arithmetic, but there's a fair bit behind this in terms of understanding how this stuff works. So far, so good. Okay, I got a question. Where does this thing break down? What am I assuming in this very, very simple analysis? Am I not assuming that when this $1 million comes in next year, the revenues are $4 million, costs are $3 million, there's $1 million left over? In generating this number, have I not assumed that I could take that money and invest it at 10% each year? Well, I have, because this factor here is F given P, 10% comma 3. By that very nature, I'm saying, yeah, when that $1 million comes in, I can invest it at 10%. Is that a good assumption? Well, if I'm an engineering company, and I've got clever engineers, next year, hopefully, there'll be more projects that will pay at least 10%. So when that $1 million comes in, we'll take it, put it into 10% projects, and we will indeed grow that $1 million by 10% or more. If that's the case, then this number is a good estimate. But let's say we've got engineers from Ryerson, and they can put this money in at projects that only pay 7%. What happens? Isn't this number wrong? Because we're assuming that our engineers are clever enough to find homes for this $1 million, $3 million, and $2 million at 10%. And if our engineers are not clever enough, this number is wrong. What do I do in that case? Well, think about that. If I'm an investor in this company, what would I prefer? Taking $1 million and reinvesting in the company at 7%, that's one option. Or why not? Remember, companies can pay dividends. Why not, if all this company has are 7% projects, why not just pay out $1 million in dividends? Yeah, me as an investor, I've got $1 million, and what am I going to do? Well, my opportunity cost is 10%. Why not take that $1 million and put it in another company, by assumption here, at 10%? So the key thing is, yes, this number is good, no matter what. If it's a good company with good engineering prospects, they keep it inside the company, and it grows by at least 10% because this company's got good engineering prospects. If the answer is, this isn't a real mature company, there are no other opportunities, this money cannot be invested at 10%, 7% for example, then give the money to the shareholders as dividends, and then they can grow the money outside of the company at 10%. So the fact that it's generating $1 million is the important thing. And whether within the company or outside of the company, it can grow at 10, doesn't matter. Because the shareholders in the end don't care whether they're getting the value from here or from over there. So it's a good model in terms of estimating shareholder value no matter what happens inside the company. You know, hopefully a company does have good things, and this is then a cheap form of financing because it's got $1 million without going to the market to get $1 million. So it doesn't matter. But the key assumption here is that cash flows, and as we'll see throughout the course, everything we do, the company has the ability to invest at the opportunity cost. That really means one of two things. Yes, it does, or no, it doesn't. And no, it doesn't, we just pay that money out to shareholders who will go elsewhere and get 10%. Doesn't matter. But implicit in the analysis is this 10% reinvestment rate in everything that we do for the rest of the course. And it doesn't matter. So this is, I hope, the more intuitive view in terms of why is this a good project? Well, it's a good project because this number is greater than 0. And if this number is greater than 0, the project cash flows return more than the opportunity cost, which is what the investor could have done elsewhere. Hence, it's a good project. Similarly, if this number is greater than 0, the present value will be greater than 0. So if I'm measuring a project from this point of view, oops, wrong way, sorry. If I'm measuring a project from this point of view, if this number is greater than 0, it's a good project. Because if this number is greater than 0, the future value will be, the investor will be wealthy. That's the key thing. So just some simple arithmetic here, but really fundamental in terms of trying to understand what's going on in this course. Okay. And again, the symbols that we use in terms of future value. Okay. These are simply F given P, so we figure out the timing of the cash flows, and then use our opportunity cost or cost of capital generally to value those cash flows. The only thing that doesn't get adjusted is A sub n. The cash flow at the end of the project, for the last example, n is 4, because that money comes in exactly at the time you're doing the valuation. It has no chance to earn interest. So A sub n has no adjustment. The one coming in the time period before gets adjusted by 1 plus I, because it's in the company for a year, rolling it out, and ditto for the rest of the year. And again, A0, normally negative, because it is investment. And F given P, what we call the future value. Okay, so I guess I just want to very quickly sum up, and we'll talk about this next day, in terms of I have the ability at 10% to move cash flows around to suit the needs of the problem. Sometimes the business situation doesn't lend itself very well to the tools that you have at hand in terms of the formulas to do valuation. And what this slide is all about is saying that if I have future values, if I have present values, if I have intermediate cash flows, as long as I move money around at 10%, everything is equivalent, or I don't care. So in other words, if I know that this project has 1939 worth of value, present value, Well, and I want to know how much wealthier is the shareholder beyond the opportunity cost investment. I can do one of two things. I can say, well, these are the cash flows, so each one of them individually bring forward. So I've got 4 F given P's. Or I can say, well, if all of this is worth 1939 here, then it must, at 10%, be worth F given P 10%, comma 4 here. Because we have the ability to grow money at 10%, or earn 10% on money. Similarly, if I know that the future value is 2840, and I want to say, well, how much your share price is going to go up as a result? So I know this number. Well, I either do a P given F of all of those, or I just say, well, this is the value then. I have a 10% cost of money, so P given F, 10%, comma 4, brings it to here. Okay, so I have that flexibility as a time value money to move cash flows around to suit the needs of the problem and the formulas that I have to work with. Okay. And we'll show that a little bit more next time when we talk about annuities and how we need to adjust things to use the formulas very easily. So anyway, that's all I have to say today. So have a good Thanksgiving weekend.